The latest report by the IMF fund reveals a major shift in the global economic landscape. Emerging market economies within the G20, including India and China, they both are now playing a pivotal role in shaping global growth. Now, traditionally seen as recipients of economic shocks, these nations have become active contributors with their domestic crises across the borders. Well, key findings indicate that shock originating in G20 emerging markets, particularly China, have doubled in magnitude since the early 2000s. Surprisingly, these shocks now rival those emanating from advanced economies. Now, China's struggles, marked by high local debt and a declining property market, are major drivers. The report highlights that these domestic shocks can explain up to 10% of output variation in other emerging markets and 5% in advanced economies. Additionally, Russia's economic shift towards Asia is likely to alter the direction of these economic ripple effects. The IMF has revised its growth outlook for these G20 emerging markets downward. Now, the average growth rate of 6% per year witnessed over the past 2 decades is expected to slow to 3.7% in the medium term. The IMF urges policymakers in these emerging economies to build buffers and strengthen their policy framework to navigate potential economic shocks. The slowdown in growth for G20 emerging markets could have a domino effect, hindering progress in other economies around the world.
Don't stay abroad. They're not buried in mattresses.